Okay, well, welcome everyone. Thank you so much for joining us today. This is Boost Your Credit IQ, Unlocking the Basics of Your Financial Power. And our organization is American Consumer Credit Counseling. So again, if you are not familiar with our organization, we are a nonprofit credit counseling agency. We're a national organization, but we're based out of Boston, Massachusetts. And our main mission is really to give people, empower people with the knowledge and tools to really regain control over the financial parts of their lives. So this part of our organization, this webinar is part of our financial education program, but we also have a counseling side to our organization that is more one-to-one. So if we go through this presentation and you would like a little bit more assistance and you want to speak with a credit counselor about your personal situation, we offer a free and confidential financial assessment. And so you can check us out at consumercredit.com to get more information. You can also call 866-675-0990, and you'll get in touch with one of our fantastic credit counselors like Tunika, who can really go through your budget and do a soft credit poll and really help you kind of understand your own personal kind of financial picture. If our debt management program is a good thing for you, we can help you enroll in that. We are also we're also certified in several different areas. So we are also certified as pre and post bankruptcy counselors. So we can also assist with that. And then we are also do reverse mortgage counseling as well. So we really have a couple different aspects of our organization where we really try to help people with the knowledge and tools, again, to make some good financial decisions to get in the best place that they can possibly be in. So again, my name's Marika Vanderheel, and I'm the Community Outreach Supervisor. So I'm in charge of the financial education program here at ACCC. This is my colleague, Tunika Green. She's a credit counselor. She is based out of the New York area. And so she will be, in this presentation, it's always great to have people who work with us who have some credit counseling experience. So Tunika, you want to talk a little bit about maybe your work as a credit counselor?
Sure. Can you hear me okay?
Good.
Wonderful. Good morning, everyone. How are you? Yes, so I've been with American Consumer Credit Counseling for approximately a year now. I'm going on two. So basically, credit counseling is it can be intense sometimes. You're speaking with a lot of different individuals who have, a large amount of debt. It can be, I mean, it can range from, from two to almost 100K in credit card debt, but you're assisting them with just trying to find a way of balancing their home expenses, their everyday expenses like household expenses, transportation, and ensuring that they're able to pay their everyday expenses in addition to their unsecured debt, and also hopefully having some type of surplus at the end of each month. So creating and building a budget definitely helps our clients with balancing their home life and as well as their everyday expenses and their unsecured debt.
Great.
So that is my job day in and day out.
Lots of experience. So, and just so, because in doing this presentation, we want to definitely let you know that we're not financial advisors. This presentation is really meant as an educational presentation. So we want to give you some information for you to make the best decision for yourself.
Absolutely.
So what we're going to do is in this, we're really going to explain how credit works, credit reports, credit scores. We're going to look at some ideas of how you can build or repair your credit if there's been some damage or you have a relatively thin credit file. We're going to look a little bit about how to tackle some credit card debt and why that's an important thing to think about. And then finally, we're going to wrap it up with a very short look at really how to make your credit cards work for you and your situation, how to get the most out of your credit cards. So that's today's agenda, and it's quite full. So before we jump into any kind of presentation about credit, we want to make sure we understand what credit is. So credit is really the ability to borrow money. It's a loan. When we say credit, sometimes people think credit cards, but it is in fact any line of credit. So this could be a student loan, a personal loan, a mortgage. This could be a credit card or a department store card. Anywhere where someone is giving you the ability to borrow money is a loan. There are two conditions that come with this that are understood, that you're promising to pay this money back to the lender and that you're agreeing to the interest rate and terms that the lender sets. Now we're going to talk about interest rates a little bit further in down the presentation because it's really important to understand what are the interest rates that you're agreeing to and what does that mean for the cost of the loan. So why is a credit profile so important? Why is it so important for everyone to know what's on their credit report? Before someone lends you money, or it could be before someone actually offers you a contract, they're going to want to look at your payment habits. Are you going to be high risk or low risk? And this is what's determined as being credit worthy. And so, what's your credit worthiness? And so, sometimes decisions lenders or other kind of people make about starting a relationship with you will be determined based on what's in your credit report or what is your credit score. So, it's really important. And again, knowledge is power. So, the more that you know, and the more that you can take steps to improve that, the stronger your situation, the better it is. So, how is credit a building block of all of the financial power? First of all, you want to have the most favorable application. You want to have the best interest rate. So, having a higher credit score can mean that you have a lower interest rate. It also shows proof of positive money management. So our credit reports kind of show part of our spending habits. And so there are other things like rental housing, job insurance, utilities, phone service, which can be impacted by what people see on our credit report. It also can mean, however, with really positive use of credit, that it can mean more money in your pocket because if you can really kind of negotiate lower interest rates or better terms, or get your interest payments down to zero on credit cards, that's more money that's back in your pocket and not being paid towards interest charges. And then the last thing that really is using credit cards to pay yourself back rather than paying credit card companies. So those are some of the pieces that building this financial power and leveraging money in the best way that you can. So Tanika, I don't know if you want to add anything onto that, but that's just kind of like the why this presentation is so important. So
I was just going to say, no, it's very important to understanding that factor because we have a lot of clients that are unaware of how their credit card works and
mhm,
how the interest rates work. So it's important that, you really read, and, we never read those fine lines, which is the most important. But sometimes it's really in bold print when they give us the terms of the agreement of,
mhm,
your interest rate is 27.99 or 34.99, and that annual fee sometimes you don't even notice it that
right.
is tacked on top of the interest rate. So you're not only paying almost 30% on interest on top of every purchase that you make, but in addition to that, annually you're charged between, I think, maybe 60 to maybe even 100 with the annual fee.
Yeah, it can be
So it's
anywhere from 35. I've seen it up to $500 annual fees. So it can be,
oh wow.
yeah, it really ranges depending on the card. And again, there's that idea that we want the most money to go back into your pocket. That's the goal.
Right.
That's the main piece. So what
Hmm.
we're going to do in this piece, Tanika and I are really going to kind of take apart what's on your credit report and how is your credit score determined? So the parts of your credit profile live kind of in two places. One place is your credit report, which are all of the records of your financial history. So from the first time that you open your first line of credit, could be a loan, could be a credit card, that begins your credit profile, your credit report. And that credit profile will be in existence until you pass away. There are many people who have never seen their credit profile. They know their credit profile, their credit report has been pulled, but they've never seen it. So it's really important for people to know they have access to their credit report and what is on that. The other thing that is used is a credit score. So a credit score takes information from your credit report and gives it a numeric value based on different weights of the information. And this is really used to determine your credit worthiness. So these two pieces kind of are the parts of your credit profile. So what's on your credit profile? The first part is all of your personal information, your name, your date of birth, your social security number, current address and old address, phone numbers, and current employer. And the reason why I have name, date of birth, and social security number starred here is because these are three pieces of information that you want to keep protected. So you want to know when someone's asking for this information, you want to be really careful about who they are and what they're using that for, because this is the information that can be used to then clone an identity in identity theft and people open lines of credit under your name. It can also be used in applications for different services where people, maybe in the small print, are going to pull a credit report on you to look at your credit habits. And so it's really important that you know when these three pieces of information are being used and what they're being used for. The other thing that one of the other things that is on a credit report are public records. And really, it used to be a lot more. It used to have foreclosures, judgments, liens, wage garnishments. But under the public records section, currently it's only bankruptcies. Some of these other kind of issues may show up under the payment history, but it's not separate in the public records. The biggest part of your credit report are going to be all of your credit accounts. So all of your credit accounts in good standing will be listed here. They will also have all open credit accounts with any maybe negative or adverse information. Some credit reports will have it, they'll show it, but some may actually pull those accounts out separately. It will actually list all of your closed credit accounts for the last 10 years. And this may not impact your credit score, but it will really, really impact how a lender will view you. Lenders love to see closed credit accounts in good standing because it shows positive payment history. It shows that you can take on lines of credit, pay them down, and you're a low risk borrower with really good payment history. Payment history is the largest part of the credit report. And this is the part where it's sometimes hard to determine with what is underneath all of this. So it will be the payment history, loan type, date opened, the credit limit, the monthly payment amount, if it's a fixed amount, current balance, amount and date last paid. And then interestingly, on a credit card, it might also list, I've seen on credit reports, the highest balance you ever owed on that credit card. Now, what is really going to show up and what is really going to be the heavy weight is your payment history. And so under this, really what you want to make sure is that all of your payments are paid on time and are current. If you have had a payment that has been 30 days, 60 days, 90 days, or 120 days late, under that particular date, it will show up and it will say 30. So on your credit report, it will actually say how late that payment was. And so it's important so creditors can see or lenders can see how late that was. If the lender tried to get in touch with you with late payments and you have not replied and you have not gotten in touch with them, they may send that debt to a collection agency, and that will be listed on your credit report as it's gone to collections. It could be as well if it's gone to collections and you still haven't communicated with the lender or the collection agency. The lender may determine we're not going to keep this account anymore and we're going to close this account. It's called charged off, and it will show as charged off on your credit report. You still owe the debt. It just is the lender is not keeping that line of credit open anymore. If you miss house payments, mortgage payments, there could be a foreclosure, or if you have car payments and you haven't made the car payments and there's a repossession, that will show up under these payment history as some adverse or negative information. So this is the biggest part of the credit report and the most important.
Okay, so this is also very a huge part of when discussing or trying to understand when you're going in to apply for like a credit card or if you're applying for a car loan and things of that nature. And this is when it comes to your hard inquiry and a soft inquiry. Now, with a hard inquiry, it is just an in-depth look into your credit, and it's usually like looking to borrow money, right? So, like again, it's for your mortgage, pre-qualification, car financing, secured credit cards, sometimes, credit card builder loans and unsecured loans like a personal or student loan, credit card companies, and department store cards. Now, with a hard inquiry, this is going to appear on your credit report, and it may drop your credit score by a few points. With a soft inquiry, you're looking at your financial habits. So banks, when they're opening a new account, employers, landlords, if to see if there's any landlord-tenant issues, utility companies, cell phone providers, insurance companies, um, it varies. But with the soft inquiry, it does not show on your credit report. So people are very scared oftentimes when you're getting your credit report pulled, like, well, is this going to show on my credit report? It depends on the nature of what you're looking into and what you're applying for. And that will dictate whether or not it's going to be a hard inquiry or a soft inquiry on your credit report and how many points you may or may not lose. Now, no one can dictate that. That's the one question I often get a lot of times. Well, how many points will my credit score drop? No one knows that. I can't dictate how many points a credit score is going to drop when it comes to a credit inquiry, and especially depending on the creditor or the company that you're going through. It depends on your history. This is just from my knowledge, I believe, it's from your history, your payment history, and that creditor. But again, no one can dictate that. No one can control the negative or positive notations on a credit report.
Just so you know that for utility companies, if they look at your credit report and there's some negative information, then they can't deny you service, but they could ask you to put a deposit down. So,
Right.
it could be one of these pieces that when a bank pulls your credit report, they could say, sorry, we can't open an account with you. And so some people can deny you a contract based on what they see, but utility companies can't deny you a contract based on what they see in your credit report.
I was also going to say, I believe also with some cell phone companies, um, and like home phone lines and things of that nature, they may ask for a deposit from you, especially if they see that your credit history or your payment history is like a little off or it's not consistent. So they may ask for a deposit as well. Now, this is for information timelines and credit reports. So this is how long positive and negative notations on your credit report will remain there. So as far as like, let's say you have an open revolving accounts and it's in good standing, that will stay on your credit report indefinitely. Hard inquiries about 2 years from the last inquiry. Closed accounts in good standings for about 10 years from the closure. Now, adverse information like late or missed payments, that's going to stay on your credit report for about 7 years from the original delinquency. Collection accounts, that's going to stay again on your credit report for 7 years from the original delinquency. Foreclosures, repossessions, or settlements, 7 years from the original delinquency. Chapter 13, bankruptcy, 7 years from their filing date. And Chapter 7, bankruptcy, 10 years from the filing date. So I would definitely make a notation of these timelines and how long it will remain on your credit report because oftentimes people will say, well, I made that payment, I took care of that debt. Yes, but and however, the next creditor is looking at how long it's been since you actually taken care of that debt, and that will remain on there. So that's what they're basing their decision on when they're looking at your credit report. Not the fact that you paid it off, it's the fact that how long it's been since you paid it off and how long it took you to address the debt. Now there's three credit bureaus, reporting agencies. Okay. So we have Experian, Equifax, and TransUnion. Now these are the three independent credit reporting agencies. Now some creditors report to one bureau, but not across all three, and you can update the other bureaus on your own. I have a lot of clients, well, for us here at ACCC, we pull through TransUnion because oftentimes you may have a creditor that does not report to TransUnion where we may not know of. You can obviously provide us with your creditor's information to include them in our program. However, you have to understand not all companies report to all three reporting credit agencies. This is why we always encourage each client that calls in who's unsure about their credit report, who's unsure about the debt that they have, that they should pull their free annual credit report. And the website that you see here, annually, you can pull this credit report and you can go through each one, Experian, Equifax, and TransUnion to see what reports have been placed on your credit reports, what creditors are, reporting you as either delinquent, past due. This is very important because this helps you to stay ahead of your credit and it helps you to address any derogatory statements on your credit report and to address your credit rating. So this right here is like gold to you. Honestly, it's needed, it's necessary because if you're unaware of what's on your credit report, you can have sometimes fraud and people don't even know. Like, I never had a Gap card or I've never had a Kohl's card. There oftentimes department store cards open up under your name and you're unaware because you're not pulling your credit report because everyone thinks, well, I have a good credit rating. It's decent. It's fine. However, it could be great if you actually pulled your credit report and did the work to go through it with a fine-tooth comb to figure out what's on there and what's been reported against you, either positively or negatively. But that gives you the power to dictate how your rating goes and how it's being reported. Sorry, Marika, did you have anything you wanted to say in that regards?
Yeah, I was just going to say that it's just really important because I think a lot of people think only lenders can look at the credit report and they just don't
Right.
realize that like by law, you have free access to, each of the credit reports from each of the three bureaus once a year for free. And the
Mm-hmm.
annualcreditreport.com is the place to go that you can pull them all at the same time. And as Tanika had said, the information might not be the same across all three credit reports, and this may be something you want to fix because you don't know if you go to open a new line of credit, you don't know which credit bureau that lender has that relationship with. So your experience score may be okay because you can see that, but you don't know, like you say, what your TransUnion is. And so each of these can be, you can get a free copy of your credit report, but they don't come with scores. So the question I always get is, how do you get your score for free? And we like going to kind of the primary source, which would be Experian, Equifax, TransUnion, or annualcreditreport.com. So you can go to Experian and Equifax and open up a free account with them, and you can see your FICO score with them and your credit report for free. TransUnion, you need to have a paid account to view your score, but you can also view your Vantage score, which we're going to talk about in the next couple slides. You can view your Vantage score through some of your credit card apps. So we're going to talk a little bit more about the score, but it's really important to see what's on your report, and that totally impacts your score.
So as I was mentioning earlier, as to why you check your credit report, it could be minor issues, incorrect information, or outdated information. Oftentimes, there's certain things that you can contact the creditor and say, "I paid this. Can this notation is incorrect?" Or you just need to address anything that's derogatory on your credit report that doesn't appear correct, or it just seems like it could be fraud. And again, that could be holding up your credit score. So that's very important for you to check it annually. And if you can, if you're eligible to, or you're able to, sign up for one of these reporting agencies. I know everyone's like, oh, well, I have this account or this agency I check my credit report, my credit score with. That's great. But for you to truly find out in detail what's on your credit report, I would sign up with one of the three credit reporting agencies because that's who your creditor is actually reporting to about your pay history. If you're delinquent, that's where you want to go. I understand we all kind of use these, online apps that just tells us, okay, well, your credit score is this, or, you're doing fine in this regards. But if you truly want detailed information, I would certainly have your annual credit report pulled, and I would sign up for either Experian, TransUnion, um, or just Experian, and Equifax. Sorry, slipped out of my head. Um, and also there could be, could be major issues like identity theft. And again, account information could be wrong. You want to contact the credit bureaus. You want to provide supporting information to ensure that you are who you say you are. The investigation takes between 30 to 45 days. It's a while, but at least it's worth it, especially when it comes to your credit history, especially when it comes to your identity. Even locking your credit report is also something you should keep in mind, and you're able to unlock it. Let's say if you're applying for, I have a lot of clients that call in, they say, well, my credit report's locked. Perfect, not a problem. Please feel free to unlock your credit report and you can lock it back. But that provides another sense of security and protection for you and your credit history. Okay. And now once it's resolved, and you will provide a new credit report. Now, if negative information remains, you can add 1 to 2 sentences explaining why it's still remaining on your credit report. Okay.
Yeah. And I think it's really important because, like you say, you want the information on your credit. You want to know what's on your credit report. You want it to be 100% accurate, because that's a reflection of your payment history. And so if there is something that's incorrect, like say you were 30 days late and not 60 or 90 days, as it says on the credit
Hmm.
report, you want to make sure that you go in and kind of fix that through a dispute. And so that's really important to do. So
And I
the
think that's what a lot of people don't know is that you can
Yeah.
actually dispute negative notations on your credit report. You can't change it. There's no way of just actually going in and just changing that, but you can dispute it, and you can do that right through your credit report and contacting the creditor in a credit reporting agency.
hmm And if there is some negative information, if life happened, you lost your job, COVID, another kind of life event, and there is some negative information on your credit report, again, it stays there for 7 years, but don't think that it negatively impacts your credit or your credit score for 7 years. The further you get away from that event, the more your score is going to improve and the less it may impact you when you're applying for a new line of credit. But some people really like to put that a little bit of an explanation. So under the personal information, you can actually add a statement that you're actually saying like what happened. And it's fairly short, 1 to 2 sentences. But for some people, they like to have that explanation added in. So that's an option as well. So that's the credit report. And then I'm going to tackle the very complex topic of credit scores. And again, as I started to research this myself, I had my own questions around credit scores. Um, I have the Experian app, and then I have the Vantage score through one of my credit card apps. And when I check both, my score is never the same. And I've spoken with some people in other presentations who say, I have this, third-party app, and my credit score is this, but then when I went to apply for a car loan, the lender said my credit score was that. Which score is right? I get that question. Which score is right? The short answer is they both are. So why are there so many different scores? It's because there are three different credit bureaus, Experian, Equifax, and TransUnion. And as Tanika had said, they're three separate agencies. And so one lender may report to one agency, but not across all three. There are two scoring agencies, FICO and Vantage Score. So we don't know which version or which scoring agency the lender's using. There are also many different score versions. So the most common now is FICO 8 and Vantage 3.0, but they're coming out with new versions. And there are industry specific scores. So that person who was looking for the car loan, maybe the lender was using kind of a FICO auto score where she was looking at something different on her third party app and they were using a different metric. So there are many different permutations. So within all of these kind of pieces, There are possibly 35 different credit scores. The score that matters is the one that the lender is using, whichever credit bureau version, score, version and metric they're using, that's the one that's going to determine your interest rate. So that's the important piece. And you can't control this, which one they choose. What you can control it is your positive credit habits, what you can do to bring up your score as much as you can. But know that your score may be in a range, and don't worry if there is no one score. It's just the system. So what is a credit score? A credit score was developed by Fair Isaac and Company. They've now shortened it down to the FICO score. And they developed it from 300 to 850. So that's kind of the score range. They take parts of the credit report and they weigh the credit report and give it a certain kind of weight. And then based on that information, your credit score can be higher or lower. And the higher your credit score, the lower you are as a risk as a borrower, and therefore the lower your interest rate. The lower your credit score, the more damage that you've had on your credit report, or the higher your debt level, the higher the risk borrower you are. And so that would be where lenders would give you a higher interest rate because of that. Now, the numbers that are listed on the screen here, where we show kind of good at 670 and above, and then maybe exceptional at 800 and above, these may change slightly depending on the lender. Again, the lender might use a slightly different metric. It might be 640 and above is good. It might be 770 and above is exceptional. So it's different. It's different, depends different on different lenders. Um, there is a second scoring agency, and Vantage Score was created by the three credit bureaus, Experian, Equifax, and TransUnion. They use the same 300 to 850 model, but again, instead of using five categories, they use four. And again, they're slightly different, but again, it just depends on what the lender's using. So the numbers that you see here on the screen are it's a general average. It's not a specific one. So how are these scores determined? And what are some of the influences that, like, what are the factors that influence your credit score? For both FICO and Vantage, payment history is the top and the most important thing. FICO measures it at 35% of your credit score, and Vantage score is 41%. So Vantage score weighs it a little bit heavier. For the second biggest impact on your credit score is your credit use or your credit utilization. FICO weighs this in at 30%, and then Vantage kind of mixes credit utilization, total balances, and available credit at like 28%. So you can see here of your entire score for FICO, 65% of your score is your payment history and the amount of credit that you've used, and somewhat similarly for Vantage as well. There are some other factors that come into play. And this is, Tunika had kind of spoken about this a little bit earlier about like credit inquiries. How having credit inquiries, how is that going to impact my score? It depends on which metric they're using and how many inquiries you've had. So we're going to unpack the next three in the next couple slides. So it is a little bit complex here. So one of the things that might impact your credit score is the length of your credit file. So again, what lenders are really looking for is when they go in and look at your profile, they want to look at your payment history. They want to see, are you making payments on time? How are you juggling your debt? And so the longer the credit file, the more information they have. So one of the things that you can do to improve your credit profile or kind of maintain your credit profile is to really identify your oldest credit card. So look at that oldest credit card, try to get that payment down to zero, and then keep it active, maybe with small charges each month to pay down to zero. Because as Tanika said earlier, the revolving credit, like credit card, if it's kept in good standing and kept open, it can stay on your credit report for indefinitely. I've had a credit card for I think over 35 years, I've had the same credit card. And so I'm going to keep that credit card protected because that keeps my credit length open. Now, we do want to put a caution here because sometimes we can't protect our oldest card. So if the card has a high balance, or it has a really high interest rate and it's too much, then it might not be a good option to keep it open. Managing inquiries. So Tanika had spoken about this a little bit earlier, just in that sense of they stay in your credit report for 2 years.
Mhm.
So again, you want to be really careful in the number of inquiries. If you keep opening new lines of credit, they add in and they'll stay there for 2 years. And the more inquiries you have, the lower impact there. So we can't say exactly because we don't know the quite metric, but you want to keep them to a minimum because they'll fall off after 2 years. A little kind of thing that many people don't know. If you group your inquiries together over a 14-day period, the credit bureaus realize you're most likely shopping for one thing, and they'll count it as one inquiry. So, say, for example, you're doing car shopping and you're looking at four different car dealers for financing. Go to all four dealers over a 2 week period, 14 days, get pre-approval to see where you are. And those four inquiries on your credit bureau will count as one inquiry and not four. Now, if you spread it out over 4 months and do, inquiries once a month at different dealers, it's going to show up as on your credit report as four separate inquiries, which will have a little bit more of a negative effect on it. So, um, just something to think about. And then the other thing we spoke about at the very beginning was really know the interest rate. Know the interest rate that you're paying because that interest rate, those charges can really add to the cost of the loan. And so what I did here was I kind of pretended that we were buying a car. So I went onto one of the car dealerships, the car sites, and kind of pretended to buy a car. And you can see the FICO score when I put in kind of where my FICO score was. Their ranges are slightly different than the one I showed you on the previous slide because maybe this is the metric that they're using. So you can see the excellent 720 and above, that's $322 a month. The average, which is 600 and above, is $375 a month. So if we're imagining one person has a credit score of 740, they're paying $322 a month for that car. Someone who has a credit score of 640, they're paying $375 a month for that car. Now, we've done the financing for 72 months, so we know that the difference in those two loans, it's going to be $53. But if we times the 53 by 72 months, that actually comes out to be $3,800 $16 for the same car, but it just costs different because of the credit score, because of what the qualification for the credit score. So one of our big recommendations here at ACCC is when people are thinking about making a big purchase, like a car, is to pre-plan a couple months in ahead and really begin to pay down their credit card debt to try to get their score up. And the more that they can move their score up the field, the lower their monthly payment will be because the interest rate is lower. And over the life of the loan, they're going to pay less. So again, the
Mhm.
main thing we want is money back in other people's pockets. So pre-planning a little bit will save you so much money in the end. So yeah, it's important to what you pay on your debts now will actually save you money in the future. That's kind of the
Long run.
takeaway. Yeah, the takeaway from this.
So next we're going to get into how to build and repair your credit. Okay. And this is really important because this is like why we're here. Um, you want to know the importance of paying your credit cards on time and making sure it's within the statement cycle. So you want to make sure it's in that time frame. So you're make sure you're paying your bill before it's due. I know say, you should pay your bill if it's due, like let's say the 24th. I always try to pay my bill maybe on the 22nd or 23rd. So by the time the 24th is here, it's already been applied to my account. Like I was mentioning, building your credit determines on your payment history, your credit amount, your credit history, your credit mix, and your credit inquiries. For payment history, you want to apply for a credit builder's loan, right? And this is again to build your credit. And we are going to touch base on each one of these factors. So I don't want you to think that I'm just going to go through this list. No, we're going to touch on each one of these as we go through the session. But applying for a credit builder's loan, applying for a secured credit card, adding rent and utility payments to a rent reporting agency. And you can see if your office management or your landlord reports your payment history to a rent reporting agency. That's important as well because that will determine on if you're moving and how your next landlord or building management will determine if you're a good tenant or not. So I would look into that as well. And also being added as an authorized user to someone else's accounts will also help to build your credit report because it will show payment history. It will show that you're staying within good standing and it will actually help to build your credit score. Now, your credit amount when using your credit card, you always want to pay down the balance for zero to each month. Now, my general rule of thumb for me is if I can't afford to pay it off in full, then I don't need it the following month. And if you're trying to build your credit, I would say buy something lower cost, maybe between $30 to $40, depending on your budget. Pay that off the following month. Do it again the next month. So then that way it shows a good payment history because yes, it's small payment, it's small purchases. However, it's still reflecting positively on your credit report because you're making full payments. Your credit history. You can open an annual fee, a no annual fee card or secure card as soon as you can and keep one credit card active. Let's say you have two. Use one of those cards. Make the minimum payments on the other, but use one card and pay that off. But that helps you create a payment history. It shows that you're paying on time and you're not going above your balance. And again, we're staying within the credit utilization um, metric of being under at least 35%. Mixing installment loans, for a credit builder with revolving credit cards. And lastly, credit inquiries, which is something we've covered already. If you're applying for a car, a mortgage, we know that now it's a hard inquiry on your credit report. Now, if you're looking just for an apartment, things of that nature, and what a soft credit inquiry is. So you really want to be careful with how many inquiries that you're having pulled on your credit report, which Marika just covered. Stay within those guidelines of if you're looking for something like you said, like a vehicle or a home, and it's back to back, that looks better on your credit report. So you just want to be aware of how many times they're inquiring on your credit report. With a secure credit card, this would be ideal for, let's say, a starter card for like a younger person, like a parent with a younger child to help them start their credit journey. Okay. You'll make a deposit with a lender and then they will give you a secure card with a credit limit between 300 to 500. Use the card and pay it down to $0 each month. Now, it can come with a high interest rate, but again, your payment history will determine and dictate if that is going to increase or if it will be lowered. Now, once your payment history is established, if you're doing the small payments like I mentioned earlier, you're making a purchase of $30, $40, $50, you're paying that off each month. Now the creditor is seeing like, okay, this is a reliable person. This is a reliable customer who's making their payments each month. They're not a high risk, you know. They're showing us that they're capable of being responsible. And now you can become or have an unsecured credit card. Now, this may also increase your credit limit if you can show that your payment history is consistent. You can also look for a no annual fee credit card. You can look for no hard inquiries and also check for lower interest rate as well. NerdWallet and Motley Fool are good to try to locate these type of cards if you're interested in looking into a secure credit card for yourself or your child.
Of all the four kind of credit builder loan products we're going to be talking about, this is actually the best for everyone. Young people, people with a thin credit file, people who have damaged their credit. This is actually the best of all of the ones that we're going to introduce. So I'm going to introduce three more kind of credit building products to you, but they might not fit for every situation. So the next is a credit builder loan. So a credit builder loan is like a traditional loan, but slightly different. So with a traditional loan, someone lends you money and then you pay them back in installments. With a credit builder loan, you go with a lender, you set up the terms of the loan, how long, and the monthly payment that you're comfortable with, the interest and fees. It's not free, so you're going to have to pay for this. And then based on that, then say, for example, you can afford $150 a month for a year. You're going to then pay the lender $150. They're going to put it into a secured account, and then they will report it to the credit agencies as a loan payment, as an installment loan payment. And they'll do this every month, and they'll report that and they'll put that money aside. When the loan ends, they'll close the loan because it's an installment loan. They'll return the money to you. So it's a great way to build credit as well as to save some money. But we always love to caution people because not every product is good for everyone. This is good for people who have little to no debt and who do not have a lot of high credit card debt. So if you have a lot of high credit card debt, your focus should be taking that $150 and focus that towards paying down your credit cards and not trying to take on a new line of credit that you might overextend yourself and damage yourself. Um, if you're interested in a credit builder loan, in my research, Wallet Hub and Business Insider are good places to comparison shop for some credit builder loans. But again, it's a good credit building product, but really good for people who have little to no debt. Another credit building product that is out there are rent and utility reporting services. So, unlike mortgages, mortgages show up on your credit report. Rent payments are not reported and utility payments are not reported. So, there are rent reporting agencies which will work with landlords and management companies to take the rent payment that you make and report it to the credit bureaus. Now, you can check with your landlord or your management agency to see if they already use a service. If they already use someone, that's great. But if your landlord doesn't, you have to make sure that that is something that will work for you. It's not free, so you may pay anywhere from like $7 a month to $95 a month. So again, you have to weigh, is this worth it? Is what I'm paying going to have a significant impact on my credit report, and my credit score? In the research, it looks like this will be good for people who have little to no credit, again, in credit building, little to no credit, or someone who has a very low credit score. But again, everything comes with pros and cons. Not every rent reporting agency reports to all three bureaus. So when you're doing your research, make sure they report to all three bureaus because you want to make sure that that's getting captured. Not all score versions, some of the older score versions actually don't calculate rent reporting in on it. So you may be doing rent reporting, but the lender may be using an old score and it's not helping you. And then you also want to be really careful because if you don't pay on time or you have issues, it can be a negative impact. So rent doesn't hurt you if you make a missed rent payment, but if you use a rent reporting agency, it can be negative information. So NerdWallet actually has a really good article on the pros and cons of rent reporting. And then the last one, which is to become an authorized user. And this would mean that someone has a credit card account. They are the primary account holders, and they would be someone who they would add you onto their account as an authorized user, not a joint. So it's not equal. You're just an authorized user. Now, this would be something that the primary account holder would get the card. and they could give you the card or they could keep the card themselves and you're just added on to their coattails on the account. You cannot, as an authorized user, you cannot make any changes to the account and you are not legally liable for the debt. So if you are a primary account holder and you want to add somebody on as an authorized user, when you give them that card, any debt that they accrue, you are responsible for that debt. So just be really mindful. Again, it doesn't fit everybody. So it is really good maybe for younger people that can be added onto their parents' accounts to help build credit. Because again, you want to have a trusted family member or friend, but you do not want to be on an account with someone who has negative payment history or has a lot of credit card debt because you attach yourself to their credit profile, it can actually bring your score down rather than improving it. It's also something that if the primary account holder has a lot of debt or is making late payments, you can actually ask to have yourself removed from that account. And because you were an authorized user and lenders and credit reporting agencies, because you're not liable for the debt, they will actually kind of don't count it as much as like a 100% of an account because you're not liable for that debt because you're not the primary account holder. So authorized users are good, but not for every situation. So you have to make sure it works for you and it works for the situation.
So next discussion is going to be repairing your credit. Now, this is something that I kind of touch on a lot with my clients, especially when it comes to their payment history and them affording like the minimum payments. Um, sometimes some of my clients cannot afford the minimum payments. I suggest that they make some type of a payment. Making a payment is better than not making no payments at all. And if you can make a minimum payment of something within on the due date, great. And then if you could pay the remainder later, that's even better. Or within the same time frame, that's just as good, but you need to make a payment. Skipping a payment is just only going to hurt your credit rating and it's going to hurt your interest rate in the next billing cycle. That's quite important. So I always try to encourage each of my clients to just, if they can, try to make at least the minimum payment. Now, for your credit amount, as far as like your credit utilization, and the best way to tackle it, and what I always try to explain to my clients is that try to figure out your credit utilization by dividing your credit card balance by your credit limit, then multiply that by 100. Now your goal is, like I said, is to get it below 30% on all your cards, right? No new purchases on cards, freeze your card to pay off balances, and use cash or debit when possible. But try to limit the amount of debt accruing on your credit cards. Your credit history, keep your oldest account open. It's okay if you need to close cards for debt management. Oftentimes, a lot of customers are scared to close their cards because they're worried about, well, if I close my card, then that means that I'm not a good client or I'm not a good customer or it reflects badly on my credit report. Actually, as a consumer, it's kind of encouraged that you close your card opposed to your creditor closing your card because the notation that's being placed on your credit report. You can close your card as long as you're making those payments. So yes, another creditor will see that you close your account. However, you're making monthly and consecutive payments, so it's going to reflect positively. So yes, it may be a slight drop in your credit score because obviously you are closing an account. However, you're making monthly and consecutive payments in a debt management program, which will show that that debt is being paid back. Credit mix, don't worry about the mix. Not a high percentage of score. And credit inquiries, try not to open any new lines of credit or new credit cards. That's another question I always get often. Well, if I'm in a debt management program, can I open new cards? I never suggest any client open additional credit cards because the whole point of kind of working with a debt management company or trying to address your credit score, if you're closing out accounts and your goal is to kind of improve your credit rating and your credit worthiness, opening up a new credit card is only going to hurt you because now you have access to new debt. which means that you're going to charge, you're going to shop, and it's going to ultimately end you and will set you back, and you're going to be right where you started. Just be wary of debt relief, and credit reporting scams. Oh, so I get this all the time. Oftentimes, like customers or I could see customer clients will call in and they're like, "Well, someone told me that they can fix my credit." No one can remove negative notations on a credit report. They cannot. They will try to get money out of you and say that they're going to fix your credit. It's ultimately going to hurt you in the long run. Debt settlement companies, oftentimes they're going to charge you 35% or more. Again, it's going to hurt your credit report. They're asking you to not pay your creditors. That's always a bad idea. Yes, essentially, it sounds amazing because you know what? They say, I can have you pay less than what you owe. But on the short end, you're going to end up hurt because your credit rate's going to go down. All the negative notation that's going to be placed on your credit report, it's going to ultimately hurt you. And you're then still paying 25 to 35% or more on top of the initial debt that you already owe to a debt settlement company. So although they're saving you money, they're still charging you. So ultimately, you're still paying the same amount.
Yeah, I think the big piece I think with this is just be if something sounds too good to be
Too good
true,
to be
sometimes
true.
sometimes it isn't. So it is. And so that idea of like our organization is a credit counseling agency. And so we are a nonprofit organization. So really try to do your homework before you kind of like try to take on any of these debt relief or credit repair. Make sure that you're doing your homework and you're not kind of getting into a predatory agency. That's the biggest piece that we wanted to kind of include here. So we're going to talk about how to improve your score by really lowering your credit card debt. So that's what we're going to tackle kind of in this next section.
Okay. So paying your credit card debt never goes down. Now, with this situation, they did not pay their balance in full last month, and they owe approximately $1,285.74. They paid the minimum payment of $33. They were charged $19.93 in interest. Now, if they only pay the minimum with no new charges, it will take them 4 years and 10 months to pay off the car, and they will pay approximately $720.36 in interest. Now, again, this goes back to what I was discussing earlier. I understand I said make a payment, but it's best to try to get that full amount paid down because you're ultimately going to be paying what's their interest rate? Did they show the interest
It
rate?
didn't show the interest rate.
Okay.
So yeah.
Well, oftentimes the interest rate is either 20% or more. So
Hmm.
imagine like if you just had paid the what you owe in full, and again, always try to purchase what you can pay back that following month. I know I don't want to say any names, but certain credit cards where you make a purchase and you have to pay the full amount the following month. Think of it that way. You
Hmm.
don't want to have that lingering debt because each month that interest rate is going to increase. So that's why every time it's like, well, I'm paying the minimum balance, but I'm not getting ahead. Well, that's why, because that minimum balance is primarily being taken care, well, it's primarily going towards the interest rate the interest, I'm sorry, is even going towards the interest and not the principal balance. So that's why you're not seeing a dent in the debt that you owe because the majority of that payment is going towards the interest.
Right. And
And
that's
that's what,
I think that's a
sorry,
major frustration that you hear, Tunika, is like, but I'm paying my cards. Why am I not getting anywhere? And I
right,
think people don't realize, but I am making them an payment and my debt just isn't going down. But then when you really look at that math of like $33, $20 of that 33 is going to the credit
interest
card
charges.
company. Yeah.
Hmm.
And only 13 is going towards the debt. So that idea that really having that idea to instead of trying to have like minimum payments and maybe a little bit more than minimum payments on all the cards that you have to try to really do minimum payment and then choose one card to kind of
Hmm.
super focus in on and try to pay that down and then put that card away and then keep moving forward. But we hear a lot of people who are just they're really frustrated because they keep paying and they're just not getting anywhere.
Right. But I always suggest if they can, if possible, even if it's for 6 months, to freeze their card. So
Hmm.
that way they're not, because it's like the expression I get all the time, I hear all the time, it's robbing Peter to pay Paul. You're making payments, but then you're using the card. You're making payments, but you're using the card. And then you're only making the minimum payments, which isn't really covering the the principal balance of what you owe. So you're literally still digging yourself in a deeper hole the more that you have access to this credit.
Right, right. So we're going to look a little bit here at like how to do that. What does that look like? So one of the things we talked about under your credit score, the second most important factor is credit utilization, how much credit you're using. And so this can actually lower your credit score. And a lot of people don't realize that the debt that they're carrying on their card is what is one of the biggest factors in their score.
Hmm.
So what we would like to have people do is to really look at all of their credit cards to determine what's their current balance total and then what's their total credit limit. And then what you're going to do is take your current balance, divide it by your credit limit, times it by 100 to get a percentage. And so we can see here that my total credit usage is 52%. And unfortunately, 30 anything over 30% is considered high, and so
Hmm.
anything over 30 is going to negatively impact your credit score. The higher your credit utilization, the lower your credit score. So this is
Yep.
my overall credit utilization, but and a lot of people don't realize this, you can also get double dinged by having high credit utilization on one of your lines of credit, one of your credit cards. So in this example, credit card number two, I have $9,000 debt on a $10,000 credit limit. And so I have used 90% of my credit limit. And so that credit utilization is 90%. So I have 52% of my overall credit utilization, but this second card is incredibly high. So when I look at credit card number one, which has a zero balance, what I'm going to do with that one is put that card away. I'm not going to use that card. Credit card number three has a balance of $2,800 on it. But what I'm going to do on that one is just make a minimum payment on that card. And then what I'm going to do is start taking a brown bag luncheon, stop drinking coffee outside the house, pick up a side hustle, cut a streaming service. I'm going to do whatever I can to get extra money to make as much of a payment I can make on that $9,000 debt to bring it will bring my overall credit utilization lower and my individual credit utilization lower. So as I'm tackling credit card number two debt, my credit, and I'm using cash and debit, I'm not using my credit cards, my credit score will slowly increase. So the what you want to do is to like lower your overall credit usage and your individual credit usage. But again, if this is something that would struggle to do on your own, this is where a credit counselor, this is what Tunika does, and this is what our colleagues do. So if you do need some help tackling this particular thing, please give us a call at the 866-675-0990 number, and it's free and confidential. We can walk you through like what might be the best strategy for you.
That's actually what I was discussing earlier when I
Hmm.
was giving. I think maybe it was the wrong point of the
Hmm.
presentation when I was discussing dividing your credit card balance by your credit
Yeah,
limit, then multiplying it by 100 will help you to understand where you lie in your credit utilization on
yeah,
your credit cards.
yeah.
Yeah.
Super important, super important. And so this idea of, you know, looking at kind of your overall piece to improve your score, again, make that determination. Sit down and do some math on like where you are with your credit utilization to be able to kind of decide which cards you're going to do minimum payment on and which cards you're going to do that extra payment to try to tackle that down. So set that payment plan for yourself or seek out assistance if you need some. So how do you make your credit cards work for you? This is the last part of the presentation. And so we're going to go through this kind of quickly. So credit cards really should be considered as safety nets. So sometimes we need to carry a balance on our credit cards. Life happens, things happen. We don't have the money in the bank, but we don't want to take a loan out. So credit cards are good kind of short-term loans if you need them. So, but don't treat them like a long-term loan because the interest rates are too high. So if you need to make a purchase, if something happens with your car, at the dentist, whatever it might be, and you need to put that charge on your card, then instead of doing the minimum payment like we showed on the previous slide, which was like the persistent debt where you never seem to be paying it down and you're going to end up paying huge amounts of interest charges. Think about, okay, I have this debt. Can I pay it down in the next 3 to 6 months? And what is that going to look like? And then how much, interest rate how much am I going to be charged for this? And how quickly can I pay this down? So think of them as short-term loans, not long-term loans. And so, is it an emergency? Then yes. And then try to figure out when you sit down and look at your whole credit profile, try to determine which cards are your low credit limit cards, and those maybe are your safety cards. If it's something that you can't afford and you want to buy it, how are you going to pay it off? How long will it take you to pay it down? And then what are you going to need to give up to make this happen? Are you going to need to not do takeaway lunches and bring your brown bag in? How are you going to change your spending habits to make this thing possible? So this is just an example here down below of, say you want to buy a new bike and the bike is $2,000. Your APR on that credit card is 24.99%. The minimum payment is going to be $60. If you only do the minimum payment, it's going to take 209 months to pay it off, and you're going to end up paying $3,711 in interest charges. That's more than the cost of the bike. If you set yourself a pretty aggressive payment plan and you're going to pay it off in 5 months, so you're going to pay you couldn't afford a $2,000 bike, but you can afford a $500 kind of credit card payment. You're going to pay that off in 5 months. You're only going to end up paying $110 in interest charges. So again, we want to view credit cards as short-term loans, not long-term loans, because the interest rate can really hurt us. So this slide is an example of when you need to put something on your card, have a plan in place to pay it down. And then we do get questions here about annual fees versus no annual fees. And have a look at your credit cards to determine which ones of your cards have no fees and which have annual fees, and how much you're being charged for those annual fees. Um, Annual fee cards are good if you don't qualify for a no annual fee
Mhm.
card. So to have a no annual fee card, you actually have to have a little bit of a higher score. Annual fee cards, there are some cards that will credit card companies that will give you a card if you have a lower score, but they might charge you a higher annual fee. So if you need that, we would actually say go for the secured card. Instead of paying an annual fee, try to get with the secured card first. An annual fee might be good for you if you are someone who you pay your credit cards down to zero, so you're not paying any interest charges. And you're someone who you use that card to earn points, cash back, or travel perks, whatever travel miles. If you are someone who you can use the benefits and the perks, if it's something where like the cost of the ticket, the checked bag, the time in kind of waiting the security line, hotel upgrades, cash back on kind of your spending. If all of those actually make you money, then the annual fee balances itself out. But if you can qualify for a no annual fee, there are some cards out there that actually have some good cash back, no annual fee with some good cash back. But annual fee cards might be good if you literally use your credit card as a safety net. You don't use your card regularly, and you would prefer to use cash or debit, and you don't spend enough in the categories to earn points. So maybe then the annual fee card would be better for you. So really just sit down and look at your lifestyle, your choices to see, is this card really, am I making money on this card? Is this really
I mean, it's
benefiting me?
to
Or
me, yeah,
am I paying money on this? Am I paying too much? Go ahead, Tanika.
right.
What would you add in on
No,
this?
I was going to say the same thing if it was beneficial for me, because that's what we were discussing earlier. As far as
Yeah,
like when you have a card that, you're charged between, it could be, like I said, what, between 69 to, like you said, $500 and an
$500.
annual fee. And then if you've already have a balance on that card, and then that annual fee comes around, and now you have that annual fee that was just taken out and the balance that you're carrying over and the interest rate. So you want to take all of that into consideration, especially when you're applying for these cards, because it's there for you to understand and know. And oftentimes we do look, over it, but
Mhm.
if you see that annual fee. I personally, I agree with Marika. I will go with a secure card rather
Hmm.
than a card with the annual fee because it ends up um, having you like you're basically digging yourself in a hole
Hmm.
eventually if
Right.
you're not paying it in full.
You're,
If you're not paying it in full.
Exactly, exactly. And when you're trying to build your credit, if you have a lower credit score, secured card is you get that money back at some point, where with the annual fee, you're just paying the credit card companies. So, yeah, I had an annual fee, a pretty high annual fee, but it was a travel card and I used all of the perks. And then my lifestyle changed. And I moved back to the States and I didn't use all those travel perks. So the annual fee didn't work for me, so I actually called my credit card company and downgraded my card to a lower annual fee. So you can actually kind of shift and change some of these things to make sure credit card companies want to keep you. Maybe you just need to shift and change your plan.
I think another thing that a lot of clients and individuals don't know is that you can make adjustments to your card. If you want to lower your credit card limit, you can. You can all call in and ask, like, well, I would like to lower that. I've done that before, and I don't, I was scared because, like, well, I didn't think I could. And I was like,
Mhm.
no, I want to lower that, until became more knowledgeable about my finances and how things work. And I was like, okay, well, I also have, power to dictate how you know, my credit card debt and my credit card balances will work. It's not always in the creditors um, to say, how should be if you can increase or decrease it. You have a
Right.
say in how you choose to either leave that card open, close it, or even lower your limit. You
Yeah.
have the right to do that.
I
And I don't think
actually
a lot of people don't know that.
Yeah. And I actually called one of my credit card companies and said, "Can you change my payment due date? I'm a little OCD. Can you change my payment due date? Because I want all my credit cards to be due on the same day. So I just pay all my credit card bills on the same day." And I
Right.
was able to kind of negotiate a change of when my payment date that suited me. So,
Right.
it never hurts to ask, so it's always
Right.
good.
And I think we're not encouraged to do that. And I think
Hmm.
that's what we're not encouraged to kind of get a copy of our credit report. We're not
Hmm.
encouraged to kind of contact our creditors because we feel like they have all the say in our to dictate what happens with our credit cards and our
Hmm.
credit report. But that's not true. We have some power and some
Yeah.
say in that.
Yeah. The last slide I'm not going to go into too deeply, but it's like how you sit down and can crunch some numbers. Like, is the annual fee really worth it? So you can sit down and do some comparison shopping between credit card products to see, okay, this credit card product has a $95 annual fee. And in the end of kind of all of my calculations, I'm going to end up making $205 back with all my average spending, where another card might have no annual fee, but they have maybe not as high a cash back process. But with the same amount of spending, you get back $150 at the end of the month. So it could be something depending again on your spending and depending on your lifestyle. Just sit down and crunch some numbers with your annual fee cards to see if that's actually really beneficial for you. And that's where you can kind of do some comparison shopping. So this is our last slide.
Positive credit card habits, paying cards on time. I think we touched on that a lot. Just making sure that you're making sure you're paying. Like I said, if your due date is again the 24th, if you can pay it before that, I would suggest that you do, just so it can be applied to your statement in time. Oftentimes, like you can pay it on that due date, but if you pay it a few days before, then it's already reflecting positively on your credit statement that you've already paid in full before the due date. But still, try to pay your cards on time so it can positively reflect on your credit report. Um, if you have a debt payment plan, keep your credit card use low. Try not to exceed more than 35% of the utilization. Again, general rule of thumb is you want to divide your credit card balance by your credit limit, then multiply that by 100. Use your credit card balance, divide that by your credit limit, then multiply by 100, and that will show you how much of your utilization that you're using on your credit card. Pay more than a minimum payment if you can afford it. If you can't afford it on that date, try to pay it within that month. So by the time your second statement comes around that is paid in full, you may still tack on fees because it's late fees. However, at least that minimum payment is paid in full. But try to pay as much as you can within that month. And also, again, contact the credit card companies, like Marika said, see if you can push out your due date to give yourself more time to make that payment. So that can also save you a little bit more time and heartache as far as like fees. Keep your credit inquiries low. You know the difference now between hard inquiries and soft inquiries. Don't be alarmed, but always ask when you're going into an establishment if it's a hard inquiry or a low, I'm sorry, or a soft inquiry. So that's where you know if you're going to move forward with this company or not, and if that's something you want to do, considering the last time you had an inquiry on your credit report. Have a specific use of your cards. Annual versus non-annual, which is what we just covered.
Mhm.
Figure out if it's going to be beneficial for you long term, not just in that moment, but long term. If you know that you have a credit card, if you're just establishing your credit, and if you are unable to get a no annual fee card and it has to have an annual fee, try to make smaller purchases. Use it for like gas, groceries, small bills like Netflix, something that you can pay for in full the following month. So that way, eventually, you can then build up your credit to where you're paying this off and now you're eligible for a no annual fee card. And this card you can set in the back burner, you can freeze it, you can put it away. You don't have to use this any longer. Yes, you'll have the annual fee, but that's the only amount that you'll have to pay on that card, in addition to any um, um, monthly payments. I can't get it. Your minimum
Interest
payment. Sorry,
payments, yeah, interest,
interest.
yeah.
Yes, thank you. Your
Mhm.
interest payment. And keep your oldest credit card open. I would say if you're entering into a debt management program, the one thing I always suggest to clients, although their oldest card may have a high balance, I would still tell them to keep that card open because that's their longest credit card history. And I wouldn't suggest they close that card because that basically reflects on the moment they have the card up until this point. So it's going to reflect all of their purchases, their payments, and that's not a card that you really want to close because, like I said, it shows your entire credit card history. That's a card that I would suggest paying down on your own if you can, but enter any credit card that you've just recently opened, even if it has a low balance, high balance, enter those cards. But if you can, try to keep your oldest credit card open. It's beneficial for you and it's beneficial for your credit score and rating.
If you are feeling really overwhelmed with your credit, please feel free to reach out to one of our counselors. Again, our consultations are free and confidential, and we stay on the call with you as long as you need us to really walk you through what's going on. So you can give us a call at 866-675-0990, or you can check out our website at consumercredit.com if you want to know more. But if you like these webinars, if this is a series that you like, the next webinar in November is financial harmony. So when we do budgeting with people, sometimes people have their own budget that they're dealing with. They're trying to kind of budget for their children and plan for their children's future, as well as aging parents. Sometimes as adults, we're actually helping our aging parents. So in November's webinar, what we're going to really talk the topic we're going to tackle is kind of budgeting across three generations. And then in December, we're going to go large to small, and we're actually going to talk one person, one budget strategies for single living. So there are a lot of benefits for someone as being single with their own budget, but there's also a lot of challenges with being the only income. So we're going to tackle that in our December webinar. So you can check us out and sign up for those webinars if you would like. And then last but not least, I'll put this in the chat before we let you go, but we are a nonprofit organization and we love all the kinds of feedback that we can get. We are looking into our 2025 webinar series. So if there are webinar topics that you would like to have us cover, please complete the survey. Let us know. We really would love to kind of create a webinar for you. We have webinars that we generate ourselves, but we would love to know what you're really interested in.